Hello, and welcome to Insights on Selling to and Working with Private Equity, presented by the FEI Houston chapter. Thank you for joining us today. Before we get started, we would like to share some information regarding Cpe credits with you, and we appreciate your patience. Today's webinar is worth one continuing professional education credit. To be eligible for Cpe credit, you must answer at least 3 of the 4 following questions on the slide screen during the webinar and have a total viewing time of at least 50 minutes. Participants will have the opportunity to download their Cpe certificate immediately following the webinar if the requirements are met. In accordance with the standards for the National Registry of Cpe sponsors, Cpe credit will be granted based on a 50-minute hour. We are unable to grant Cpe credit in cases where technical difficulties disqualify eligibility. Cpe program sponsorship guidelines prohibit us from issuing credit to those not verified by the technology to have satisfied the minimum requirements listed. I encourage you to download today's PowerPoint presentation, which is located in the resources window on the lower right-hand side of your screen. After the presentation, this webinar will be available on the FEI member site where you can replay and download. At the conclusion of the webinar, your Cpe certificate will be available in the certification window and will also be emailed within 24 hours should you meet the criteria. Below the speaker biography window is the Q&A box. Please feel free to ask questions throughout the presentation, and the speakers will answer as many questions as possible. It's now FEI's pleasure to introduce FEI Houston Chapter President, John Briscoe. John?
Thank you, Michelle. Good afternoon and welcome to the Financial Executives International BoyarMiller webinar, Insights on Selling to and Working with Private Equity. I am John Briscoe, President of the FEI Houston chapter, and I hope everyone is staying safe, and we appreciate your ongoing support for FEI. I want to welcome our FEI Houston members from other FEI chapters, and guests. If you are a guest and want to learn more about FEI, go to the national website at financialexecutives.org or the FEI Houston website at feihouston.org. You can also navigate to the websites for the other 65 chapters across the U.S. I also want to thank BoyarMiller for their support of the Houston chapter. Today we have a great presentation that will provide some unique insights and discuss some of the details associated with transactions with private equity and working with a private equity investor post-transaction. With that, let me introduce our speakers for today's event. Steve Kesten is a shareholder and business group chair with BoyarMiller in Houston, and John S. Castle is president and CEO of Brandford Castle Partners, based in New York City. Steve, I'll hand it over to you.
So thanks, John. So we at BoyarMiller are thrilled to be presenting again to the FEI membership. John Briscoe, you may recall that we were one of the first presenters, I think, on the On24 platform back when this COVID thing just began. So we're glad to be presenting again. Let me quickly tell you a little bit about my background and how it relates to this program. So I consider myself a deal lawyer. I do a lot of deals where we are buying and selling companies. I've got a lot of different additional experience in the corporate arena, but probably 65% of my practice is in the mergers and acquisition area, buying and selling companies. And then even a little bit more interesting is that I probably spend about 65 to 70% of my time representing sellers of companies. And more often than not, when I sell a company, I end up selling it to a private equity company. And that's one of the reasons why I'm really excited about being able to present this program today. What is even more exciting is that I reached out to my friend in New York who runs a private equity company, John Castle, and asked him to join me today so he can give you the real insights as to how private equity works. And then real quickly, let me just tell you about some of the things that we're going to talk about today, and then I'm going to turn it over to John so he can start in on the presentation. So first we're going to talk a lot about, how what is private equity, how does it work, how does it transact, What are some of the structures of how they buy companies? We're going to talk about what's going on in the M&A market, how private equity dealt with COVID, and things like that. So to get things rolling, I'm going to pass the baton over to John, who's going to tell us a little about himself and his company, and then talk about the inner workings of private equity.
Fantastic. Well, thank you very much, Steve. And first of all, I very much apologize for the tie today. I get a sense that maybe I'm a little bit overdressed, but I'm a New Yorker, and I think these ties have become commonplace, and I just had to wear one today. So my apologies for that. But look, my firm, Brandford Castle Partners, is a 35-year-old investment company. We focus on making control investments in operating businesses with under about $100 million in enterprise value, which usually corresponds to about $100 million in sales. We invest in a wide range of industries. The commonality amongst the industries, though, and the deals that we do are that we like to buy the #1 player in a specific industry, in a specific niche. And hopefully that company will have what we perceive to be strong proprietary or sustainable competitive advantages in the marketplace. We are control investors. Well, what does that mean? It means at the board level, we have to have 51% voting control. When we make an investment in a company, we really need to make sure that we have control over the outcome of that investment. So we need to have that voting control. It's very important to us. That having been said, we work very closely with and in conjunction with management. Typically, we are working with management to help build their companies or make them more efficient. But no matter what the needs are of that business, we sit down with management to discuss exactly what needs to take place and put together a strategic plan with them. We have a long history of successfully growing businesses, taking them to the next level. And I think that is shown in the returns that our portfolio company CEOs have made in their rollover investment back into the company. The last three of the last 4 platform company CEOs that we've worked with have made 8, 30, and 45 times their rollover investment. So again, in concert with management, we think that we've done a great job at helping these companies again get to the next level.
All right, so tell us about the history of private equity.
Sure. Well, look, hopefully this is a bit of a brief primer for everyone. For those who know everything there is to know about private equity, we won't spend too long on this. But first of all, private equity has been around for a while, for almost 60 years. I think the picture of John F. Kennedy here is, has private equity been around since the Kennedy administration? It either has been around or it got started shortly thereafter. But nonetheless, this is still a great picture of one of our great presidents. So it's been around for a long time. This is not a fly-by-night industry. It's grown to many trillions of dollars in size. So what does private equity do? Well, at its basic level, it brings together capital from investors into a pool. From that pool, it makes investments specifically into operating businesses. It will, again, work with those businesses to expand, to get to the next level, whatever it is they want to accomplish. But then at the end of the day, that private equity will need to sell its investment in that company because it needs to return that capital to the investors that put money into its pool in the first place. Usually that takes place in about 3 to 7 years, but it can take longer. It can be shorter if the goals are achieved in a shorter period of time. In terms of the investments that are made into those companies, typically a private equity firm will utilize debt in addition to the equity that it puts in to complete the entire transaction. Most private equity firms that are good at what they do will, again, work with management to decide what the right capital structure is for that company and not overly burden the company with debt, because that can lead, obviously, to very difficult circumstances. But why don't we flip to the next page, Steve?
Done.
So I think the thing that we need to start out with, because we get this all the time, is what is private equity and what is it not? Many of you have probably seen these great movies from back in the 80s, the original Wall Street movie and Pretty Woman, where, the protagonists were called in to, as private equity investors. They would invest and then they would slice up the companies and sell off the parts. It is possible that there are still some private equity firms that do that today, but that is not what 99% of the industry does. And it certainly isn't what investors in our end of the market do. For starters, the companies under $100 million in sales aren't big enough to, to cut up and sell off the pieces. But that's not where returns are made. I think 99% of private equity firms these days are in this to grow the companies that they are invested in. That's how they make their returns. And then that leads us, I think, to the next page, where we can show more along the lines of what private equity does. Again, most groups spend all of their time thinking about how to help their businesses grow, and then beyond that, how to help them be more efficient. The big way that at least Brandford helps with our companies in terms of growth is organic growth. We will help grow product lines or develop sales forces, or help develop additional product lines or different areas of growth within the company itself. Another way to help with growth is to acquire other businesses, utilizing a core business that will then, you'll bolt on these smaller businesses to that one, and there'll be synergies, and it'll grow to the size that you want it to through that effort. There are some groups who will actually go through what's referred to as a roll-up process, where they will buy a platform business and then they will buy tens of other businesses and attach that to that company. That is not what we do. Other companies specialize in that. Again, Brandford focuses really on internal growth and one or two targeted acquisitions along the way if we can get them done. Then with regard to efficiencies, we will do thorough reviews of a company's manufacturing and sourcing capabilities. We oftentimes will bring Six Sigma best practices or lean best practices to those companies. In addition, where we can, we will help groups of our companies come together and aggregate their purchasing so they can lower some of their purchasing costs. One thing of note, everything that we do is typically put together in conjunction, again, with management prior to a deal getting done, and then we just start executing to that plan once the deal is completed.
So, on average, John, about how many transactions do you guys do on an annual basis?
So we will do about 3 platform deals a year, and then we will bolt on maybe the same number to those companies in a year. So a total, I think, of probably about 6 deals a year. There are other private equity firms that are volume shops that will, they'll do 30 or 40 transactions a year. We have more of a focused approach. So 3 platforms with 3 bolt-ons is enough for us, and it allows us to roll up our sleeves and really get involved with the companies that we buy.
Got it. John, I'm going to turn over to you, John Briscoe, for the first polling question.
Great. Thanks, Steve. Here's our first polling question. Have you transacted with or worked for a private equity-backed company? Take a look at the answer choices and be sure to press the submit button after you've made your selection. And I'm actually interested to see, I know private equity has become much more prevalent in the energy space, and I think probably just about every industry. So I'm very interested to see. Last few seconds, make your selection. Make sure you press the submit button. Now let's take a look at the results. And the results are about 35% have not worked with or transacted with private equity. I guess that's probably about what I expected, but then that puts 65% that have either been involved with a transaction and worked for, which I guess is about what I expected. So with that, I'll pass it back to Steve and John.
Okay, so about 20% of transactions have transacted with private equity. So about 80% have not. So this should be an interesting part of the program for you, because we're going to talk now about high level, how does private equity do their transactions? So John, do you want to start?
Sure. So, look, there are lots of approaches with private equity, as I've mentioned, and how you can work with them. And I think that when the first thing you want to do is you want to figure out exactly what type of transaction you're looking to enact. And then the second thing is finding the right private equity partner to help you with precisely that transaction. A lot of sellers look for full buyouts or close to full buyouts, where they'll sell their company. The buyer, the private equity buyer, will show up and give them, predominantly cash for the company, and all of that cash will be taken off the table by the seller, and they will go their merry way. That's not typically how Brandford would work in its entirety, and there's a lot of groups like us. We typically get involved in partial buyouts or substantive buyouts, where what we would do is, let's just say 2/3 of the purchase price would be offered to the seller in cash. They could take that off the table at the end of the day, but then a residual amount of the purchase price would be left in the equity of the company, so they still have a stake in the company. And again, we would like if those owners or the managers of the business, we would like for those owners/managers to stay with the company post transaction. We are a group that will, as I mentioned earlier, only do majority transactions. Again, we need to have voting control rights. There are some groups out there who will forego voting control rights and only and get involved in the company on a minority recap basis. Yes, there are some groups that do that. It's not every group. There's only a handful. The other thing that may take place, though, is that you may have to deal with a lower valuation. Giving up control rights is a big thing, and so it may be worth less for that investor to get involved in the company, and so they'll value the company or the situation less. But again, that's for somebody else to decide. Sometimes one other big part of transactions can be contingent consideration, or consideration that's paid out over time. Oftentimes, those will be part of a deal if there's a gap between a buyer and seller in terms of how much they think the business is worth, and or there is not quite as much leverage available for the transaction as needs to maybe consummate it or get to that purchase price. And sometimes a seller will be asked to leave behind a seller note to be paid out over time to help with the full capitalization of the business. Other types of transactions that are worth noting are transactions like growth capital transactions, where no cash gets taken out of the business. The growth capital will go onto the balance sheet of the business to help a business owner grow the company. So that's another type. There's also the last bit of what I was talking about earlier, which is a platform transaction, where that transaction is meant for a company that is sort of big in scale, and that there will be bolt-on transactions added to that. Sometimes deals are done by private players as for platforms, and other times as bolt-ons. And the characteristics of what that means to the sellers can be somewhat different. If you're a platform deal, again, oftentimes a private equity firm will need for the management to stay with the business. If it's a bolt-on deal, sometimes they're okay with the management not coming along, because they'll have the platform company manager to run that bolt-on business.
Yeah, just a couple of quick things to add. In my experience, private equity companies typically specialize. They're either going to be doing majority recaps, and that's a bit of a misnomer. A majority recap really is a change of control and a sale of the company. Other private equity companies will specialize in minority recap, which is really more of a correct name, because you are recapitalizing the company. The private equity group does not take a majority interest. And then some things to think about: if you are a seller and your purchase price is going to include a seller note or an earnout, if you're going to obtain a seller note, be aware that it's going to be subordinated to the senior debt that the private equity group uses to leverage the transaction and buy the company. And if you're going to do an earnout, make sure the earnout is very well drafted. If there's ever going to be litigation in connection with a sale, it's likely as a result of the earnout provision. So make sure that you've got good counsel who is familiar with drafting earnout provisions, because that is, again, a likely source of litigation. Okay, so let's dive a little bit deeper now into how sales are done. I think most of us know that either a sale is going to be through an asset sale or a stock sale, and there's a bit of a conflict here between buyers and sellers, because buyers typically want to buy assets and sellers would like to sell stock. And the reason for that is that a buyer would like to buy assets because through the transaction, they're able to get what's known as a step up in basis. It's a step up of the value of the fixed assets of the entity or of the assets they acquire. Instead of moving those assets onto the balance sheet of the buyer at the depreciated numbers that the seller had, the buyer gets to move that basis back up to fair market value and depreciate those assets again. That's a big benefit to the buyers, because under the new tax rules, you can depreciate those assets, I believe, in the first year after the sale. So you're going to substantially reduce your taxable income the first year after the sale. The other reason why buyers like to buy assets, if you buy assets, you can leave the contingent liabilities of the seller behind. So that's a big plus. And an interesting point for private equity is that they typically like to buy companies that are pass-through entities. So if you are a C corporation, it's a good chance that the private equity group is going to want to buy your assets as opposed to the equity. And then on the flip side, sellers want to sell stock and not assets, because if you sell assets, there's going to be a tax implication of depreciation recapture, which is taxed at ordinary income rates. And if sellers sell equity, then they can get the advantages of receiving capital gains treatment on the sale. So that just generally tells us how it's done from an asset versus a stock sale basis. But there are other things that might determine, or at least aid in the determination of whether the sale is going to be a stock sale or an equity sale. And in my view, it depends on the size and the complexity of the selling entity. So if the transaction is, and I picked an arbitrary split of 50 million or above, it's usually going to be a more complex transaction, because the company is going to have numerous contracts, could have permitting, licensing issues. When you sell your company and you sell it through an asset sale, the seller terminates the employees. The buyer then has to employ all those employees, so there's personnel transfer issues. If you sell equity, then you don't have to worry about any of these things, because in an equity sale, the entire company gets moved to the seller, along with all the contracts, along with the permits, and along with all the employees. And in addition, you get to keep all the bank accounts, and the seller gets to get capital gains treatment. On the flip side, if it's an asset sale, you have all these complications that you have to deal with. So depending on the size, depending on the complexity of the deal, it's possible that it will be an equity sale because of the complexity versus an asset sale. So once a deal is done, John, what's it like to work with private equity?
Of course, it's great. We're the best people to work with. Look, here's the thing: if you're selling a business, you have to, you have to know who you're selling to, and if you are going to be staying with the business and you are going to be working with that private equity firm, you want to make sure that you've done a deal with the right partner. Just as in any industries, there are personalities involved, and you have to make sure that you're happy with the personality that you've gotten married to. I think that private equity is a great avenue to pursue, because I do think that if you're interested in making your business grow, private equity brings a lot to the table. They have helped a lot of businesses grow substantially over the years. And again, I think the best private equity firms will work on a strategic plan prior to the transaction getting done, so that everyone on day one of the transaction gets, hits the ground running. Especially with, most groups will have a 100-day plan coming right out of the gates, and then like an annual plan and a 5-year plan as well. But the thing that private equity does do post-transaction is that they will remain engaged, many of them, and they'll track how everything is being done. To help track, they'll often set up quick phone calls on a weekly basis. There will be, monthly calls that will last an hour or two, and then on a quarterly basis, a board meeting will take place, and that will last for however long it needs to last. Oftentimes, board meetings can run 4 to 5 hours. But again, I think working with private equity can be a wonderful opportunity to work with a set of people who have helped businesses grow considerably over the years.
So, John, what should management expect vis-a-vis a time period to stay with the company, and what is your position with respect to a seller who is also a senior manager who is looking to transition out of the business? So,
look, I think that we may touch on this on a slide a bit later, but let's hit it now. Look, typically private equity firms like it when managers stay with the business. Private equity firms like continuity. Now, there are some that want to change people out, but that's certainly not how we do business. We would want to work with somebody who is going to be at a company indefinitely, but if there is going to be a transition, we would want to see, sort of 2 years with that person. Other private equity firms, I think, are okay with a year or 18 months on a transition. But I think that is a little bit the minimum amount of time that a private equity would like. If somebody's going to transition, it's got to, I think, typically be about that length of time.
Some other expectations that sellers should have if they are working for the company, I guess even if they're not, is that when you sell to private equity or even to a strategic, you remember that you are also going to be subject to likely at least a 5-year non-compete. So even if you do transition out of the business, it's not like you're going to be able to go and start up the same kind of business right after that. It makes sense for people that are thinking about retiring to transition out, but others who get an opportunity to roll over equity into the buyer entity, it makes sense for them to continue to stay employed, possibly enjoy the fruits of their continued labors with a second bite at the apple when the private equity buyer sells the company on the next turn. Okay, John, another polling question.
Great, thanks, Steve. Here's our second polling question. In your opinion, is private equity activity increasing or decreasing? Make your selection, press the submit button. So here we're looking for the opinion of the participants of the webinar and their experience and perceptions related to private equity activity. Give you a few more seconds, make sure and make your selection. Okay, let's go to the results and let's take a look at the results. Mm-hmm. Private equity is increasing about 65%, and that's not surprising to me. I actually think that it's increasing more than that, but it's hard to relate the answer to a particular ratio. So this was good. I'll pass it back to Steve and John.
Thank you, John. So I would agree that private equity activity is certainly increasing. The single largest reason why valuations have increased and continue to increase is the is the influx of private equity involved in the transaction process. 60 years ago, when there wasn't any private equity, it was all strategics. And as private equity became much more ubiquitous, and they're having to compete with one another to get deals, because they have to spend the funds that have been invested into their partnerships, the valuations have increased. So yeah, and it's good for sellers. It is great for sellers that private equity is part of the landscape.
So just one thing,
sure,
Steve. Just one thing that I might add to that. A lot of times it matters what industry you're in. Private equity sometimes thinks that certain sectors are really good sectors to be in, and a lot of money will push into that sector. Other times, sectors are out of favor, and you may not see as much private equity activity. So I think depending on your industry, you could be getting different impressions as to whether private equity overall is growing.
Got it. Yeah, and we're going to look at some of the statistics of the M&A marketplace in a few minutes, and you'll see that shown very, very well. You'll see it through our discussion about this particular topic. So right now, I thought I would do a deeper dive into an actual transaction where private equity purchases a small middle market company and do a little case study. So the scenario that I'm offering up today is that we've got Brad, who owns Distribution Central Inc., DCI. He has a private equity buyer that wants to buy him for $10 million in a majority recap. And Brad is going to retain 10% of his equity in this transaction, so he'll be rolling over 10% into the new entity. And then recall, as I said before, sellers want to sell assets, buyers want to buy assets, sellers want to sell equity. And this is a transaction that's below 50 million, so it's not going to be too complex. So we're going to be doing an asset sale. Here's some of the deal economics for this particular situation that we're going to run through. On the left side, you can see the sources of the proceeds for the deal. We've got the private equity group that's going to invest $3 million worth of equity. You've got Brad's 10% rollover that equates to $1 million. In this deal, we're going to have a seller note of $1 million. There's a senior lender that will be putting in $4.5 million and a mezzanine lender that will be putting in $1 million for a total sources of $10.5 million. The uses of those proceeds are that Brad's going to get $8 million in cash at the closing. He's going to get $1 million worth of equity, and you'll see what that translates to in a second. He'll have his seller note, and then we're just assuming legal fees and loan fees and broker fees of $500,000, and that's where the extra $500,000 comes from. So the way this transaction is going to work is interesting, because there's a way that Brad can sell a portion of the assets for cash, but then also contribute a portion of the assets in exchange for equity, and they're going to get different tax treatments. When he sells the assets for cash and the note, that will be a taxable transaction. But when he contributes the $1 million worth of assets for equity, that will be a tax-deferred transaction. So only the portion that's sold for cash gets taxed, and the portion that is rolled over will be deferred, and he'll only pay tax upon the next sale. And here is an actual illustration depiction of the transaction. It looks complicated, but it's really not. So let's run through it. So private equity will create a NewCo, LLC, to do the transaction. Private equity will contribute the $3 million that I mentioned in the sources of funds in exchange for its equity position in NewCo. NewCo will then borrow from the lenders, the senior lender and the mezz lender, an aggregate of $5.5 million. So with the combination of the equity infusion and the debt, the NewCo will then purchase an undivided 90% of the assets of DCI in exchange for cash and the note. So there's the cash taxable portion of the transaction. And then Brad will contribute the other 10% undivided interest worth $1 million of the assets into NewCo in exchange for his equity rollover. The equity effect of all this is interesting because even though Brad just contributed 10% of his value into NewCo, he ends up with 25% of NewCo on a pro rata pari passu basis when you compare the $3 million contribution of the private equity group to the $1 million of value contribution that Brad did. So he continues to be a 25% owner of NewCo and walks away with $9 million in cash. All right, so I thought it would be interesting for everyone to learn a little bit how private equity dealt with COVID. And John, tell us how you guys fared.
So look, I mean, just to jump right to the conclusion, I think private equity is back in business. And if you have a business that you are considering selling, there are considerations in terms of whether today or tomorrow are the right time. But there's a lot of capital in private equity that is looking to be deployed right now. And so there should be a lot of demand for a good company. I'll come back to that in a second. But look, when COVID hit, there was a 6 to 8 week period in March, April, May of last year where all we did was make sure that our portfolio companies were positioned to weather the storm. If they needed to cut costs, they did. If they needed to access PPP loans, we helped them access it. These days, we've been on the back end of the PPP process. We've been working with them extensively to make sure that they are able to get full forgiveness for those loans. But I think starting in June, what we saw was the company started to improve. And in fact, some of them started to improve quite a bit very quickly. Today, there is still a COVID hangover with many of them, but most of them are in a reasonably good spot. One or two of them just need for us to get past COVID, and we're lucky that in those instances, the banks that we brought into those deals have been working with us to provide enough runway for those companies for there to be safety. So we feel pretty good about the way things are going. But again, to get all the way back, obviously, we really need to get national herd immunity. I hope everybody's getting their vaccines so we can all get back to business as usual.
So just to chime in there, John, we felt the COVID experience, at least in the second quarter, pretty significantly. Since private equity slowed down, people were nervous about their valuations. Even in the middle of deals where we had letters of intent executed, everything just went on pause. So our business dropped significantly in the second quarter. But yeah, it has spiked back up. And we're going to look at some of the data on that. But yeah, it was a little scary, but things did turn around pretty quickly.
Actually, I think we've got the next poll question here, maybe.
Great, thanks. Okay, here's the third poll question. Have you received at least one dose of the COVID vaccine? And so this is the first time that we've asked this question in one of our webinars, and it's something we'll probably repeat in some future webinars just to track how our membership may be progressing in the vaccine process. So make your selection, press the submit button. Just a few more seconds here. And now let's take a look at the results. 29% have already received at least one dose of the COVID vaccine. Very interesting. I hear of new people almost every day, at least every week, that are getting the vaccine. So this is good news. Stephen, John, back to you.
So I'm super jealous of you 29%ers because I think I'm probably going to be after cats and dogs in getting the vaccine, and that's what I look forward to.
Just one thing that I don't think I've seen tracked, which I think is the one really important number, is that I think that, look, people who are over a certain age, obviously, are the people who are most susceptible to having the virus in a very bad way. And it would be really interesting to know, what percentage of our country, above, say, 75 years old or 65 years old has gotten the vaccine. I think the numbers that I see always sort of say, hey, look, 30 or 40 million people have gotten the first shot, but that's of the entire population, not of the specific population that is really at risk to, have a difficult time. But just a number that I think is sort of worth noting if people see it over time.
Do you want to talk a little bit about how COVID sort of created a bifurcated group of sellers, the haves and the have-nots?
Sure. So, look, coming out of that initial period, what we saw was deal activity picked back up, but it picked up in the area of those companies that either were benefited from COVID, and no one wants to say they're benefited, but it helped business a little bit, or maybe kept business somewhat flattish, where people weren't seeing the dip, and it's because in the marketplace overall, there was a significant reduction of the number of businesses that were coming to market because a lot of businesses were really impacted by COVID. So there was, at some point in time, the same amount of private equity capital chasing fewer deals. And those haves, when they went to market, I think got really big multiples. Those haves can probably go to market anytime they want and really have a pretty good experience in the market right now. The have-nots are, depending on their specific situation, probably can start thinking about what the future looks like in terms of going to market. You probably need to demonstrate that you are back to where you were before. You may not have to do that for an entire year, but maybe for a few months, if your income statement comes in and your revenue and earnings are tracking to certain levels, you may be able to go out into the market and tell the market that on a run rate basis, you're every bit what you were in the past. And given the amount of money, private equity money out there right now, it is possible or likely that a private equity firm would say, yeah, I agree, and I will pay you for a full year's earnings, again, on a run rate basis, based on the numbers that you're posting now.
Okay. I think we covered this slide with your previous discussion. Do you have anything else you want to add here, John?
No, I think we've done our best on that.
Yeah, and I was lucky enough to have a couple of clients that were the haves, and I did close deals in June and July of this year. But I also had some unlucky clients that were the have-nots, and we're still working on bringing their deals back to life. All right, so let's review just the M&A markets now and talk about where we are currently. I know this graph or chart is a little hard to see, but if you look at the far right-hand side of the page, you can see what happened in the first quarter of 2020, which was already sort of a dip in the M&A activity, and then the crushing result of the country going on lockdown with deals substantially reduced, and then a hockey stick recovery in the third quarter of getting back to a number that was more than, it looks like almost any third quarter in the last almost 10 years. But as John's going to tell us, this is a little bit deceiving because this chart graphs deals on aggregate dollar value and not numbers of deals. And I think it's going to be industry specific as to whether or not the M&A markets in your particular industry have recovered as of yet. So John, why don't you take it from here?
Yeah, no, Steve knows I think that chart is slightly misleading. I think the big deals and maybe some of the the software deals and technology deals are skewing the data a little bit. Maybe I've got that wrong too, but in the markets that we're in, the smaller markets in older economy type of businesses, there was a significant drop in the amount of activity and number of businesses coming to market. Still today, our deal flow overall is down about 20 to 25%. It hasn't completely recovered. That having been said, there are still a lot of deals coming in, and again, if you are a have company, you probably should still be able to get yourself out there ahead of a lot of other businesses if you go to market right now because of that ongoing reduction in the number of businesses in the market.
So this slide really illustrates what makes up the recovery. And if you look at this slide from left to right, you can see that in the first half of 2020, the deal size, the percentage of deals of 10 billion or above was less than 20%. But then in the third quarter, there was 34%. So the larger deals are making up the recovery as far as aggregate dollars expended in deals in the third quarter. But as John said, the lower middle market, the activity has really not been as great. And you can see that even in this chart because the deal sizes in the third quarter for the lower end was only around 19%. And then if you add, and that's less than 500 million. So if we even examined, less than 100 million, it might even be a more significant reduction. Here are some of the things that may have made up the reasons for the recovery, at least from a deal size perspective, and the larger deals. GDP went up in the third quarter. Interest rates are just still extremely low, so leverage is very easy to obtain. The Biden effect could have had an impact. And then there was job recovery in the third quarter, but then after the second wave, I think the jobs did skew downward again. All right, so M&A activity, even though maybe in the lower middle market is not quite as robust as it was in 2019, but there is a ton of activity out there. Private equity has a ton of money to spend. So we thought we'd talk a little bit about if you're thinking about selling your company in the next, 6 months to 3 years, what should you be doing now to get ready? Whether you're going to be selling to private equity or whether you're going to be selling to a strategic, you really should be working on cleaning up your house. A lot of housekeeping or house cleaning. So in that regard, you should be reviewing all your corporate records, making sure they're up to date, making sure you've got an appropriate stockholders agreement that includes a drag along, that if you have offered or sold or promised any equity to either your employees, to third parties, you got to make sure that's all papered. If there are related party transactions where you lease your facility from an affiliated entity, you got to make sure that those things are documented, make sure that if you have intellectual property, that it's all properly contributed to your entity, and things like that. And then from an accounting and tax perspective, private equity loves to see financial statements done in accordance with GAAP. So if you're not in accordance with GAAP as of yet, you should move towards that direction. Make sure you've got all your tax filings done, that you work with your accountants to make sure you're properly filing sales tax returns and paying sales tax in all the states that you're required to. And then there's one thing that John recommends if you're a seller, and that is to do your own sell-side quality of earnings in anticipation of a sale. And John, so could you mind talking a little bit about that?
Yeah, sure. Thanks. So look, a buyer is going to come in and make sure that your financial statements look, the way that, that you thought that they might, but, B, those numbers will be put into a format that financial buyers understand. And in some respects, so look, they'll have to do that. In some respects, it's helpful for sellers to undertake their own process prior to selling the business so that they know what the results of that work is going to yield. So more recently, there have been a lot more sell-side quality of earnings analyses done in advance of the transaction, and it has been very helpful for sellers to understand exactly what the numbers are going to look like. Sometimes the numbers are, reveal something different about the company's business than the owner thought, and they either have to adjust their valuation expectations, or they know to hold off on selling at a specific point until earnings get to a different or higher level. So it can be helpful for a number of different reasons, and again, it's growing in importance. Just the last thing I might touch on here, this notion of leadership I've mentioned a few times, making sure that you have a management plan in place. In a perfect world, the manager of the business will be going with the business. In a less perfect world, there'll be a transition. But one of the things that owners oftentimes find helpful, if they have been the manager of the business and they're not going to be coming with the business post-transaction, is to insert new management prior to the sale of the company, about a year or 18 months before the process kicks in, so that that new manager can demonstrate their wherewithal and convince a buyer that they are the right manager over the long term moving forward.
Okay. Well, last polling question.
Okay, here's the last polling question. And here we're trying to get some feedback from our chapter members. When the Houston chapter resumes in-person events, would you like to continue to have webinars? And I've given you several different choices here that you can pick from. There's no wrong answer here. We're just trying to get some feedback. Our webinars have been very successful, but that was all we could do. So just trying to get your input here. Give you a few more seconds, then make sure you press the submit button so your answer will be recorded. Final seconds, select your answer now. Let's take a look at the results. And the results are continue having the most popular answer, continue having webinars at about the same frequency as during COVID. I'm actually surprised. I thought there was some webinar burnout happening. So maybe this is a pat on the back to our speakers today. You guys have done a great job. People are very interested in continuing with webinars. Steve, do you and John have additional comments, or?
I've got one more slide.
Okay, back to you.
So I wanted to just touch on the Ppp Loan Program real quickly and how it affects mergers and acquisitions, buying and selling companies. And a shout out that, the second draw loans are available. Application deadline March 31st. So if you do want a second draw loan, make sure you get it in the next month or so. But how Ppp loans affect sale transactions, if the loan has not gone through the forgiveness process as of the time of the closing, then there is a requirement that the Ppp borrower either escrow the total amount of the loan plus interest or obtain SBA approval. So if you're going to be involved in a sale transaction, you need to be aware of these two alternatives. And I can tell you right now, obtaining SBA approval is a likely deal-killing scenario because of the time that will be needed in order to obtain such approval. So the alternative being escrowing is not a great alternative, but you can use purchase price proceeds to escrow with the lender, and you can get your deal done and then have control over the forgiveness process. And once the forgiveness is obtained, then you can pull the proceeds out of escrow. So just keep that in mind when you're doing your deals. So that takes us to the end of our remarks. And I think we might have a short time left in order to take some questions. So John, do you want to help us out here?
Yes, we have some time for questions, and just encourage participants to submit a question. If you do have a question, we have several that have been submitted. The first question that I have from the audience: do PE firms typically have reputations that precede them as far as being growth-oriented or efficiency-focused? And if so, how would a prospective CFO kind of kick the tires or know which type of firm they might be transacting with?
So the answer is yes, private equity firms have reputations. If you're working with some sort of intermediary on the transaction process, a good intermediary will be able to give you a general understanding as to what those reputations are. With regard to the, how you kick the tires, I don't know how to kick the tires early in a process. You may have to ask the PE firm directly, but what you can do is you can ask the PE firm for the names and contact information of the businesses that they are either currently working with or have worked with in the past, and you can go to those executives and find out exactly what was accomplished during an ownership period. That can be very helpful and illustrative as to what the focus will be for your business post-transaction.
Okay, great. I have another question here, somewhat related, I guess. Is the best way to identify possible PE buyers through an investment bank, or what's the best process?
Yeah, I would recommend that anyone who is thinking about selling a business find an intermediary. I mean, just someone to help with the process, whether it's to be able to screen some of the potential buyers for what their reputations are, or because they can hold your hand in terms of key deal points along the way. To try to get into a process without an intermediary, I think is very difficult. I think you will find that a good intermediary earns their compensation in spades because of all the different ways that they can help you get through a process in a better way.
So ironically, I think, though, that private equity groups would much rather not be part of a process because it usually bids the price up. But if you're a seller, it would be a mistake, I think, to go through a sale without the assistance of a investment banker.
Great, thanks for that. Another question from the audience. What are some of the approaches Brandford Capital uses in helping companies build out sales forces?
So, look, I think that there's a few answers that I have to that. The first thing is when we work with companies on that effort, the first thing that you got to do is make sure that the company is pointed in the right direction, right? Okay, so look, they have a bunch of different product lines, and you may start a conversation with that company, and they'll say, hey, look, we want to. We've got a great set of products here. Let's build out sales forces for all of them. We typically will come in and say, okay, you've got a lot of product lines. That's right. How about we focus on the one or two or three that will likely yield the biggest potential pop or are the biggest potential growth avenues for the business. So we'll help with some analytics in terms of where we think that we might spend our growth-related, focused time. So that's the first thing, is making sure that they're focused in the right direction. The second thing is that through our networks, we will try to bring in sales people for the specific type of company and specific type of product that we all want to market, and hopefully we'll be able to do that. The third thing is creating incentive programs for those salespeople, making sure that they are appropriately incented to get out there and get done what you want for them to get done. So I think those are the three big areas that we can help with regard to that, the considerations around sales force expansions.
Great, thank you. And we're out of time. There's some questions left, but I'm sorry, we are out of time. So I want to thank both Steve and John for a great presentation. It was really interesting and insightful. And thanks again to the team at BoyarMiller, and also thanks to Brandford Castle. Our next webinar will be in March, but we will have an executive roundtable later in February, so watch your email for additional details. Thanks for joining us. Have a great afternoon and stay safe. Now I will hand it back to Michelle.
This marks the end of our webinar. Thank you for joining us today. We look forward to you joining us on future webinars. You can find information about upcoming webinars in the resources window. Don't forget to download your CPE certificate in the certification window. Your CPE certificate will be available to download in the thank you for attending email that will be sent within the next 24 hours. If you have any questions regarding CPE credits, please feel free to email conf@financialexecutives.org. Have a wonderful day, and again, thank you to our speakers for today's webinar.
Thank you.